Welcome to our podcast, where we share our professional knowledge and experience for those considering commercial mortgages or loans. If you are in need of commercial mortgages or loans, contact us for a no-obligation free consultation. Let's start today's episode. Mezzanine Finance Guide: Essential Insights for Investors. Mezzanine finance is a hybrid financing solution that combines elements of both debt and equity financing. It's designed to help companies raise funds for specific purposes like growth and expansion, acquisitions, or refinancing existing debt. This form of financing is primarily used when a company needs a substantial capital injection and traditional debt financing, or equity financing alone doesn't suffice. Understanding mezzanine finance. Mezzanine finance is a form of hybrid financing that combines elements of both debt and equity financing. It is often utilized by companies to raise funds for specific projects, acquisitions, or to aid expansion plans. As a business owner, understanding the basics of mezzanine finance can be quite beneficial when evaluating financing options for your company. In essence, mezzanine finance fills the gap between senior debt and equity capital in a company's capital structure. This type of financing can be structured as either preferred stock or unsecured debt, depending on the specific needs of your business. Additionally, mezzanine loans typically provide investors with the option to convert their debt into an equity interest in your company, making it an attractive investment opportunity for both parties. The main advantage of mezzanine financing is that it offers a degree of flexibility for your business, as it doesn't require collateral like traditional loans. However, the interest rates associated with mezzanine financing can be higher than those of senior debt, given the increased risk that lenders take on by providing unsecured funding. When considering mezzanine finance, it's crucial to assess the potential impact on your company's balance sheet and weigh the costs against the benefits. A few factors you should consider include: lender requirements. Mezzanine lenders may have more lenient requirements compared to traditional bank loans, allowing your business greater flexibility and a more straightforward approval process. Cost of capital. Although mezzanine financing can be more expensive due to higher interest rates, it can be a preferable option compared to giving up a substantial amount of equity, especially if you expect your company's value to appreciate over time. Control and ownership. With mezzanine financing in place, you maintain control of your business, unlike traditional equity financing where you relinquish a share of ownership. This is particularly important if you want to retain the decision-making power in your company. In conclusion, mezzanine financing can be a valuable tool for your business, especially when looking to finance growth prospects or acquisitions. By understanding the key aspects of mezzanine finance, you'll be better equipped to determine if this financing option aligns with your company's needs and objectives. Types of mezzanine finance. In the complex world of finance, it's essential to understand the various types of mezzanine finance available. Mezzanine financing combines elements of debt and equity financing, giving role and risks. Mezzanine finance plays a crucial role in filling the financing gap between senior debt and equity. It is typically used in high-cost transactions such as leveraged buyouts, mergers, and real estate developments. As a borrower, you might consider mezzanine financing when you have an acquisition in mind, a management buyout, or need an injection of funds to bridge the gap between loan capital and equity. As a hybrid financing method, mezzanine financing combines elements of debt and equity financing. As a borrower, you might find it useful for funding growth or expansion plans, refinancing existing debt, or funding acquisitions. However, compared to traditional business loans, mezzanine finance is often associated with higher perceived risks. Lenders providing mezzanine financing tend to take on more risk compared to providers of senior debt. The interest rates are generally higher because of the increased risk for the lender. In the event of default, the mezzanine debt holders have a lower priority compared to senior debt holders. This means that the mezzanine lenders are repaid only after senior lenders have been paid in full. Despite the higher risk, mezzanine financing offers certain benefits to you as a borrower. For example, it can provide you with additional funding when you cannot secure a traditional business loan, or when you require a sum that a lender is unable or unwilling to provide in its entirety. Moreover, mezzanine financing gives the lender the right to convert the debt into an equity interest in your company in case of a default. This provides the lender with a potential upside if your company performs well. 6. In conclusion, as a borrower, it is important to weigh the pros and cons of mezzanine financing carefully. Be prepared for the higher risk associated with this type of financing and consider how it may impact your business growth plans. Interest and repayment structure. When considering mezzanine finance, it's essential to understand the interest and repayment structure, as it is a critical aspect of this financing option. With mezzanine financing, you will typically see higher interest rates than with traditional debt financing. This is because mezzanine finance lenders take on more risk than traditional lenders, as they are secondary to senior debt in terms of repayment priority. The interest rate on mezzanine financing varies, but it generally falls between 12% and 20%. This rate can be influenced by factors such as the creditworthiness of your business, the current market conditions, and the specific terms of the mezzanine loan agreement. In some cases, a portion of the interest may be paid through payment in kind, PIK, interest, which allows you to defer cash interest payments by adding them to the loan principal. In terms of repayment, mezzanine financing has a more flexible structure than conventional loans. These loans are usually structured with a longer term, typically ranging from 5 to 7 years. This gives you more time to repay the principal and allows you to focus on growing your business. Moreover, mezzanine financing does not require regular principal repayments. Instead, the principal is typically repaid at the end of the loan term in a single payment, known as a bullet payment. It's important to note, however, that mezzanine financing may include covenants that require your business to meet certain financial performance ratios or milestones. Failure to comply with these covenants can lead to penalties, increased interest rates, or even the lender taking an equity stake in your business. Therefore, it's crucial to fully understand the terms and conditions of your mezzanine loan agreement before committing to this financing option. In summary, mezzanine financing offers a unique interest and repayment structure that is tailored to the needs of growing businesses. The higher interest rates are balanced by the flexibility of longer terms and deferred principal repayments, while the risk of non-compliance with covenants serves as an incentive to maintain strong financial performance. Mezzanine financing in business growth. As your business grows, you may find yourself in need of additional capital to support this expansion. One option to consider is mezzanine financing, a hybrid form of finance that combines elements of both debt and equity financing. This flexible option offers you the opportunity to raise funds without relinquishing control or diluting ownership in your company. Mezzanine financing enables you to obtain a business loan that combines the benefits of equity financing with the structure of debt financing. This way, you can fund your company's growth and maintain control of your business whilst accessing capital needed for expansion or working capital. When considering mezzanine financing for your business growth, it is essential to understand how it works. Mezzanine lenders offer a loan that may be converted into an ownership or equity stake in your company if specific financial goals aren't met or if you default on the debt repayment. This loan arrangement usually involves subordinated debt, meaning it is repaid only after senior debt, such as bank loans, have been settled. Despite the potential risks, mezzanine financing has its advantages. For example, the interest rates are generally lower than some traditional loans, making it an attractive option for businesses looking to minimize their borrowing costs. Additionally, since mezzanine financing does not involve relinquishing control of your business, you have more freedom to continue pursuing your growth goals. Here are some key points to remember about mezzanine financing. Combines elements of debt and equity financing. Provides additional capital without diluting ownership. Mezzanine finance is effectively a business loan where the debt becomes an equity share after a predetermined timeframe has passed. That means if the company can't pay back the funding, the lender gets a share of equity instead. Typically has lower interest rates than some of the traditional loans. Can be converted into an ownership stake if financial goals aren't met or if default occurs. Suitable for businesses seeking growth capital or working capital. In conclusion, mezzanine financing can be an effective way to fuel your business growth, offering a blend of benefits from both debt and equity financing. By understanding the risks and advantages associated with this funding option, you can make an informed decision about whether mezzanine financing is the right choice for your business expansion plans. Cases of acquisitions and mergers. When your business is involved in acquisitions and mergers, you may come across different financing options. One commonly used method is mezzanine financing, which can provide a useful source of funds in such transactions. Mezzanine finance most often comes into play when you're aiming to expand your business through an acquisition, but need additional capital to cover the costs. This type of financing can fill the gap between senior debt and equity, making up for part of the purchase price. It allows you to obtain the necessary funds without diluting ownership among current shareholders. As a mezzanine lender, you will be providing a subordinated loan to the business, meaning that your claim on the company's assets will rank below that of senior lenders, like banks. In the event of a default, you'll only be able to collect once those senior lenders have been fully repaid. However, this increased risk usually means mezzanine lenders will be rewarded with higher interest rates or the option to convert the loan into equity, obtaining a stake in the business. When using mezzanine finance for acquisitions and mergers, it's essential to ensure that the acquired company has a strong cash flow. This is because the interest payments on mezzanine debt can be higher than those on senior loans, so the acquired business must generate enough revenue to cover these costs. If the target company has a solid cash flow and a track record of consistent growth, mezzanine financing could work well for you. It's important to remember that while mezzanine finance can provide significant benefits when used in acquisitions, it's not suitable for every scenario. You must carefully assess the merits and risks associated with the financing option, considering factors such as the target company's financial stability, your ability to service the debt, and the potential return on investment for both you and your shareholders. In conclusion, mezzanine finance can be a valuable tool in financing acquisitions and mergers, helping to bridge the gap between senior debt and equity. By carefully considering the associated risks and rewards and ensuring a strong cash flow from the target company, you can successfully utilize this method in your acquisition strategy. Application in property development and real estate. Mezzanine finance plays a significant role in property development and real estate projects. It's a flexible financing solution that enables real estate developers to secure the additional capital they need beyond traditional commercial mortgages or development loans. By incorporating mezzanine financing, you can bridge the gap between your primary loan and the equity available in your property assets. When embarking on a property development project, you might require additional funding to meet the costs of land purchase, construction, or other expenses. In such cases, mezzanine finance can help you borrow up to 90% of the total cost, thus reducing the amount of equity you need to contribute. This can ultimately accelerate the completion of your projects and maximize potential returns. Using mezzanine finance for property development has several advantages. It allows you to maintain more significant ownership in the project, as it usually involves providing the mezzanine lender with a subordinated debt position, rather than relinquishing substantial equity stakes. Moreover, repayment terms typically range from 6 to 24 months, providing flexibility in managing your cash flow during the development process. In the real estate sector, mezzanine finance is often used to fund the construction and development of commercial, residential, or mixed-use properties. One common example is when a senior lender provides 70% of the necessary funds through development finance, with a mezzanine funder contributing an additional 15 to 20% as top-up capital. This ultimately leaves you, the developer, with 10 to 15% of the costs to cover on your own. However, it's essential to understand that mezzanine financing involves higher interest rates and fees than traditional commercial mortgages or loans. This is due to the increased risk assumed by the mezzanine lender, as they hold a secondary position in terms of debt repayment. Therefore, it's crucial to evaluate your project's potential returns and expected economic climate to ensure that mezzanine financing works best for your specific needs. In conclusion, mezzanine finance can act as a valuable tool when navigating the complexities of property development and real estate projects. By carefully assessing your financial requirements and weighing the potential risks and benefits, you can take advantage of this flexible financing solution to achieve your property development goals. Role in management buyouts. Mezzanine finance plays a crucial role in management buyouts, MBOs, providing the necessary funds to bridge the gap between equity and senior debt. In an MBO, the management team acquires the business they oversee, often using a combination of debt and equity financing. This approach allows the team to benefit from the business's growth and success. Let's dive into how mezzanine finance supports MBOs. Firstly, mezzanine financing offers flexibility to the management team when structuring the buyout. Since it is a hybrid of debt and equity, mezzanine finance can be tailored to suit the risk profile and financing needs of the MBO. This means that you can optimize your capital structure, ensuring a balance between debt and equity, minimizing the amount of control relinquished to external investors. Secondly, mezzanine finance can enhance the deal's attractiveness to senior lenders. Banks and other senior debt providers often perceive companies backed by institutional investors, like mezzanine lenders, as more credible. Consequently, they may extend additional credit or provide financing on more favorable terms. This can significantly improve your ability to secure the necessary funds for a successful management buyout. Thirdly, mezzanine finance can help preserve and optimize equity ownership. Leveraging mezzanine financing reduces the amount of equity required in a buyout, enabling the management team to retain a larger ownership stake in the business. As a result, your team maintains greater control and stands to benefit more from the company's future successes. In conclusion, mezzanine finance offers a valuable resource in management buyouts. By providing flexible capital structures, enhancing the deal's appeal to senior lenders, and optimizing equity ownership, this type of financing can help facilitate a successful MBO. As a result, your management team can confidently acquire the business and pave the way for future growth and success. Regulatory aspects and covenants. When you deal with mezzanine finance, it is important to be aware of the regulatory aspects and covenants that come into play. Mezzanine financing is often characterized by having more flexible covenants and taking on riskier positions than traditional debt financing provided by banks. One crucial aspect of mezzanine finance involves financial covenants. These are terms that define specific financial ratios and performance metrics that you must maintain as a borrower. A few common financial covenants include Debt Service Coverage Ratio, DSCR, Interest Coverage Ratio, ICR, Leverage Ratio. Familiarizing yourself with the covenants set forth in the mezzanine finance agreement will better position you for compliance with these requirements, reducing the likelihood of default. In addition to covenants, mezzanine lending often includes certain guarantees and protections for the lender. These may be in the form of a second charge on assets, which provides security by ranking lower in priority than the primary debt obligations in case of default. This offers safeguards for the lender by ensuring the possibility of recourse against assets should the borrower be unable to repay the loan. You should also be cognizant of the regulatory environment governing mezzanine financing. While there is no specific regulation dedicated to mezzanine finance, it falls under the purview of various financial regulatory frameworks. For instance, in the UK, Revenue and Customs publishes guidance on thin capitalization and private equity funding, which can be relevant to mezzanine finance. Moreover, it is vital for you to comply with all applicable laws and regulations, including anti-money laundering, AML, and Know Your Customer, KYC, requirements, to ensure a smooth and transparent financing process. In summary, when considering mezzanine finance, it is essential for you to pay attention to covenants, guarantees, protections, and the regulatory landscape. Staying informed and maintaining compliance with these aspects will help you successfully navigate the mezzanine financing process. Alternative options and comparisons. When exploring financing options, mezzanine finance is not the only choice available to you. There are several alternative options to consider, such as equity finance, venture capital, bank loans, and traditional loans. Each option has its benefits and drawbacks, and the right choice ultimately depends on your specific business needs and objectives. Equity finance is one option to raise capital by selling a stake in your company. It involves exchanging shares of your business for investment funds. This approach can be beneficial if you're seeking long-term growth, but may sacrifice some control and ownership. However, unlike mezzanine finance, equity finance doesn't require regular interest payments, which can reduce financial pressure on your business. Venture capital is another form of equity financing, specifically focused on high-growth startups and early-stage businesses. Venture capital firms usually take a more active role in the companies they invest in, often providing guidance and expertise. This can be advantageous for newer businesses in need of financial and strategic support. However, as with equity finance, it can mean giving up some control and ownership stakes in your company. Bank loans are a more traditional form of financing. They involve borrowing a fixed sum of money from a bank or financial institution, which you pay back with interest over a predetermined period. Bank loans are a commonly used funding source due to their accessibility and clear repayment terms. However, they typically require collateral to secure the loan, making them riskier if your business encounters financial difficulties. Traditional loans or alternative lending options, like preferred equity, can provide funding with more flexibility than bank loans. They may offer a lower interest rate, longer repayment terms, or an option for repayment without collateral. These loans can be more accessible for businesses with unique circumstances or risk profiles, but they may still require credit checks and financial assessments to secure the funding. In summary, multiple financing options are available, including equity finance, venture capital, bank loans, and traditional loans, each with their own advantages and disadvantages. It is essential to assess your business's specific needs and objectives to determine the most suitable financing source. Conclusion. In navigating the world of business financing, you may encounter various options. One such alternative is mezzanine finance, a hybrid funding solution that combines elements of debt and equity. As you weigh the pros and cons, consider how this flexible form of financing can benefit your business. Should you opt for mezzanine finance, be prepared to handle a higher level of risk compared to traditional loans. However, it also means retaining more control over your business as you're not relinquishing ownership through equity. As a subordinate debt option, this form of financing comes with higher interest rates, which serves as a trade-off for its unsecured and flexible nature. By utilizing mezzanine finance, your business can leverage its growth potential without diluting ownership. Keep in mind that this financing option requires a clear and strategic plan to manage interest payments and maintain satisfactory financial performance. Ultimately, the choice to pursue mezzanine finance depends on your business goals, financial needs, and risk appetite. Assess your options carefully and seek expert advice as needed to ensure the best outcome for your business's future. What are the common types of mezzanine finance? There are two main types of mezzanine finance: mezzanine debt and equity financing. Mezzanine debt typically involves the lender providing a loan and taking an equity stake in your company, allowing them to participate in the potential upside of your business growth or expansion. Equity financing, on the other hand, involves the lender providing funds in exchange for ownership shares in your company. How does mezzanine financing differ from senior debt? Mezzanine financing is considered a more flexible and riskier form of borrowing compared to senior debt. Senior debt has priority in repayment and offers lower interest rates, while mezzanine financing comes with higher interest rates and a less stringent repayment schedule. Furthermore, mezzanine financing allows the lender to participate in the potential upside of your business by taking an equity stake, unlike senior debt. What are the advantages of using mezzanine financing? Mezzanine financing offers some key advantages, including the ability to raise capital without giving up too much control of your company. Since mezzanine financing often involves taking a minority equity stake, you can retain control of your business. Mezzanine financing can also help bridge funding gaps between debt and equity, providing capital for growth, acquisitions, or management buyouts. Additionally, the interest payments on mezzanine loans can be tax deductible. How do mezzanine debt and subordinated debt compare? Mezzanine debt is a type of subordinated debt, meaning it ranks below senior debt in repayment priority. Both mezzanine debt and other forms of subordinated debt carry higher interest rates than senior debt due to their riskier nature. However, mezzanine debt often comes with the added component of an equity stake, allowing the lender to participate in your business's potential upside, while other forms of subordinated debt do not typically include this feature. In what scenarios is mezzanine financing typically used? Mezzanine financing is commonly used in situations where there is a need for more funding than traditional debt or equity financing can provide. This can include management buyouts, acquisitions, and company growth or expansion projects, where an injection of funds is needed to bridge the gap between available debt capital and equity. What is the typical structure of mezzanine financing deals? Mezzanine financing deals are often structured as a combination of a loan and an equity stake in the borrowing company. This allows the lender to receive both regular interest payments on the loan as well as participate in the potential upside of the company's growth or expansion. Interest rates for mezzanine financing can vary depending on the perceived risk, size of the deal, and the borrower's financial position, but they are typically higher than senior debt due to the increased risk involved. For more information, you can contact us by clicking the link in the description of this video. Thank you for listening to our podcast. We look forward to coming together again in the next episode to share more information and experience with you. For now, goodbye.